Hi everybody, and welcome to the second in the Sequence broadcast series. Today I'm joined by Stephen Lambert, one of the lecturers from Sequence Financial Education. How are you, Stephen?
Very well, Graham. How's yourself?
I'm fairly well, thank you.
That's good.
Thanks for taking the time today to talk to us about, I believe, trade wars, something that's certainly on every news channel at the moment. So first of all, I guess the question is, what is a trade war?
Sure. Graham, a trade war results when a country, say country A, raises tariffs on another country's, say country B, their imports, in retaliation for country B raising tariffs on country A's imports. A tit-for-tat measure, in other words.
Well, perhaps, Stephen, we could just go back a tick. What exactly are you talking about when you say tariff?
Right. Well, a tariff is a tax imposed on imported goods and services. It is a common form of so-called protectionism. The direct impact of a tariff is that it pushes up the price of imported goods, thereby increasing the competitiveness of local producers.
Well, I mean, look, that sounds fine in theory, but how does it actually work in practice?
Well, generally speaking, not too well. Tariffs may look to protect and enrich a small sector of the economy, but do so at the expense of the broader economy. They put upward pressure on the prices of goods, which have far-reaching consequences, including rising inflation, given higher consumer prices. Tariffs also limit trade between countries and lower potential economic growth, thereby increasing the risk of inflation or recession. Countries with trade surpluses, i.e. where their exports exceed their imports, are usually affected the most.
Okay. Well, look, tariffs and trade wars also have, as I understand it, very far-reaching consequences across other areas. Could you perhaps elaborate on some of those?
Well, probably the most significant non-economic impact is that on international relations and the cost on friendship and trust, especially this latest trade war, where the actions of the US are alienating their closest allies. The fallout will also quite probably shift the trade balance between countries and regions, increasing ties between those impacted by the tariffs and distancing themselves from the US. There are also significant implications in regard to currency and foreign exchange rates.
Okay, well, do you think you could perhaps enlighten us about those last couple of terms there, particularly, what do you mean exactly by currency and what is a foreign exchange rate?
Sure. Well, a currency is commonly defined as money in general use in a particular country or region. A foreign exchange rate is simply the value of one currency expressed in terms of another.
Well, that sounds simple enough, but the reality is that foreign exchange seems to be an intricate and fairly complex field of finance. Is that a fair enough assessment?
It is, but it's a bit like learning to drive. Once you have a broad understanding of the underlying mechanics and nuances, things start to make a lot more sense. A crash course in foreign exchange is obviously beyond the scope of this session. We'll save that for our offline presentations. However, a logical starting point is to understand how an exchange rate or currency pair is quoted. Let's look at an example. Say the US dollar against the Japanese yen, or the dollar yen. The currency to the left, in this case, is the US dollar and is known as the base or commodity currency and always equal to 1 or 1 US dollar. It remains fixed, in other words. The currency on the right, which is the yen, is called the terms currency, which fluctuates up and down in line with market forces, i.e. supply and demand. Taking this a step further, assume the current dollar-yen exchange rate is 112.50. This means that 1 US dollar equals Japanese yen 112.50. If the rate moved to, say, 113.50, the US dollar would be said to have appreciated in value against the yen because it now costs more yen to buy 1 US dollar. Put another way, it means the yen has depreciated against the US dollar. Conversely, if the US dollar against the yen moved from 112.50 to, say, 111.50, the US dollar would be said to have depreciated in value against the yen because it now costs less yen to buy that $1. Put another way, it means the yen has appreciated against the US dollar. I like to use the analogy of an apple in these situations. A rise in the price of an apple, i.e. the fixed commodity, from say 20 cents to 25 cents, means it has appreciated in value because it costs more, and vice versa.
Okay, well look, back then to your comment about trade wars having implications for currencies and exchange rates. How exactly do you mean?
Well, a trade war can have a profound effect on exchange rates in a variety of ways. First, the most important determinant of exchange rate value is the difference in interest rates, i.e. the interest rate differential of the exchange rate currencies. I mentioned before that interest rates in the country imposing the tariffs could rise on account of rising prices and therefore inflation. All other things being equal, this could raise the value of the tariff imposing country's currency, given that it would increase demand from foreign investors to lend, i.e. invest, to that country. However, it could have the opposite effect also. If the tariff imposing country experiences an economic slowdown, or perhaps even a recession, authorities may feel compelled to reduce interest rates to stimulate demand and increase confidence. In this case, the value of that country's currency may well fall. Then there is the direct impact regarding the tariffs themselves on exports and imports, and the resulting prices consumers need to pay for their goods and services. A rise in currency reduces the cost of imports because less home currency is required to be sold in exchange for foreign currency in order to purchase those imports. They are made to become more attractive, in other words. Conversely, exports become less attractive to foreign buyers as they need to sell more of their home currency in exchange for foreign currency to purchase those exports. It is easy to see then how trade wars can have a significant impact on a country's economy, particularly those that are heavily reliant on trade, and especially those who traditionally have maintained significant trade surpluses where the value of their exports exceeds imports. And you probably gleaned also in this that in such conditions, exchange rate volatility or uncertainty can increase significantly also.
Okay, well look, you've outlined how trade wars can impact exporters and importers among other participants. What about the average consumer, and particularly, for our audience, the investor?
Sure. Well, simply put, any price movement resulting from significant currency fluctuations is likely to be passed directly onto the consumer. Overseas travel costs is a good example. Likewise, imported motor vehicles in many countries. And managing the risk is not easy, given the costs versus potential benefits of hedging in this space. Things are very different, however, from an investment perspective. What I'd say from the outset is that currency volatility as a result of trade wars, or anything else, should not be a deterrent from investing offshore. And there are two parts to doing so. First is the decision making around asset allocation, i.e. what percentage of investable funds to allocate to international bonds and equities. The second part is decision making around determining what percentage of this allocation, if any, should be foreign currency hedged. There are a number of ways to hedge or protect against adverse foreign exchange movements. The most common is to outsource to a mutual fund manager, i.e. a manager that invests in international securities and locks in the foreign exchange rate. This ensures that investment returns will only be impacted by the performance of the underlying securities in which they are invested, not by exchange rate movements. For larger investors, including family offices and small to medium-sized institutions, for example, an alternative means of managing currency risk is to enter standalone forward foreign exchange contracts or purchasing options. Again, the intricacies of these products is beyond the scope of this session, but suffice to say that undertaking the former locks in a known and certain rate of exchange as at an agreed future date, and the latter provides a worst-case scenario with scope to benefit from favourable movements for an agreed price or premium.
Well, thanks, Stephen. Any final words on this particular subject matter?
Sure, a couple of things. First, I'd like to reiterate that from an investment perspective, despite these current trade wars, which could go on for some time, likely to increase currency volatility, That should not deter one from investing offshore. International investment increases diversification, reduces risk, and presents investors with opportunities otherwise not available in domestic markets potentially. Second, that unlike consumers, when it comes to investing, there are a number of effective ways to manage currency risk. And finally, that as is the case with investing generally, the management of currency risk should be seen as a strategic exercise and not tackled on a day-to-day tactical basis. Save that for the day traders and the speculators.
Well, that certainly sounds to me like we might have a couple more subjects worthy of exploring there, particularly around risk in investing. Stephen, thanks so much for spending the time with us at Sequence, and for the rest of the audience, go to sequencefe.com and you'll be able to access more of our blog material and have a chat with Stephen. So please send through your questions on the email provided.
You're very welcome, Graham.
Have a great day.
Cheers.